Sam basically gets high, steals the family car, goes on a joyride 180 miles an hour. Maybe the police didn't stop him, but he wrapped the Ferrari around the tree. See, like that's what happened with FTX, which is they took the car off a cliff. Well, why do those laws exist? Well, they exist so that the Sam Bankman-Frieds of the world can't print their own token, do insider wash trading, manipulate the price up to $8 billion, and then tank it to zero overnight. That's why the laws exist. He could have never operated the exchange. Alameda would be out of business, FTX would be out of business, and the FTT token would be out of business if they had actually had to file a registration statement with the SEC. Because those were all insider conflicts of interest, and there's nothing ethical or legal about any of it, right? And so they couldn't have done it. And so the reason that it makes sense to file registration statements and take equities public is in order to avoid these kind of FTX, FTT frauds that basically destroy people. There is a stigma attached to related party transactions in public companies, rightfully so, because Alameda was a related party to FTX, and FTT was a related party. So Sam Bankman-Fried is the issuer of FTT, is the owner of Alameda, a hedge fund, and is the operator and owner of FTX. Those were three related parties. The reason that there's a stigma is if you took FTX public and you said, by the way, FTX accepts FTT, which is a related party issued token, and it does business with Alameda. The question that a skeptical investor would have is, well, since the same person controls all three, is it possible that he actually wired the systems to give himself an advantage? And if it turns out that Alameda has $1 billion trading loss, will Sam Bankman-Fried, the CEO of FTX, liquidate Alameda in order to protect the interest of the other customers? Or will Sam not liquidate them to protect his own interest? He has a conflict of interest. Mm-hmm. And we know how the story ends. By the way, the other question would be, since Sam has billions of dollars, $8 billion worth of FTT token, will Sam, the CEO of a bank, issue credit against the $8 billion of the token that he issued himself and give himself preferential treatment? Or will there be an arm's length transaction? If you were an arm's length, if this was an arm's length relationship and there was a disinterested financial executive running FTX, how much credit do you think they would have extended Alameda for $8 billion of FTT token? If I were to go to a bank and say, I have some locked MicroStrategy stock, will you loan me money against it? They would say no, zero. If I went to them, zero, right? The answer, by the way, to the question is a disinterested CEO of a crypto bank that was honest and competent would have lent Alameda somewhere between $0 and $10 million. So obviously that didn't happen. The reason it didn't happen is because you had three related parties all terminating with one boss, and the one boss was not honest, not competent, and not disinterested, right? Okay, what could go wrong? Well, when you have three related parties and a biased, incompetent, dishonest person, what can go wrong is the entire thing gets burned to zero.